Anyway, coming up on shows, Jason Schenker out of Prestige Economics, the president there, joins us to talk us through a lot of things, really. The turmoil in France, OPEC plus, oil and FX, plus what the Fed needs to do, what will probably do come December, what the dots probably look like. That conversation is just ahead. This is Bloomberg. Let's then talk about the U.S. story, give you a more complete macro picture going into the latter part of this week. So Fed Chair Jay Powell, of course, talking about how this economy has remained resilient, maybe opening the door really to a pause, maybe at the December 17th meeting, although he wasn't quite hawkish enough to remove pricing around that being basic. I think it's still 18 to 19 basis points of 25 that's priced for the upcoming Fed meeting. Jason Schenker is with us, president and chief economist at Prestige Economics. He's been ranked by Bloomberg as one of the top forecasters in categories, including U.S. jobs, which comes out, of course, later this week, oil prices and currencies. Jason, as always, sir, a pleasure to have you on the show. How many cuts do you have currently priced in your own models that we have for this cycle for the Fed? How low do we get?
Well, I think we're expecting at least 4 cuts next year. We still think there's a pretty good chance we could see one this month. And there's going to be probably another 3 cuts that we would see in 2026. So we think inflation is going to be here spiking probably in the next couple of reports. But then by the second quarter, and this is because of year-on-year base effects, while we might see in the November and December CPI reports that come out respectively in December and January, we could see the headline year-on-year CPI number run up towards 3%. We think we might be a lot closer to 1.5% by the time we get through the second quarter. So we're going to see this weird dynamic from these year-on-year base effects, a rise up in inflation well above the Fed's 2% level, but then we could be below that. And that could really incentivize those additional rate cuts, because the risk of beyond disinflation, deflation could become a bigger concern.
Yeah, actually, David and I were just talking about that this morning. If you were to break down the US CPI, a lot of it is sort of around that zero, even getting into deflationary territory, but shelter costs remain really high. How concerned are you about Trump's economic policies and the inflationary impact of those?
Well, there is a great deal of concern around tariffs. We did an analysis of the CPI. If you look at what's in it by category, it's something like 18 to 19% is what's goods excluding food and energy. And of course, if we look at the U.S. as a whole, right, a net food exporter, for energy, net product exporter, there are also some things that we have been exporting like LNG in larger quantities. So if we look, though, really at probably the biggest concern, which are these goods excluding food and energy, again, it's around 18, 19% of the total CPI. But that's if you include all of those goods. That's probably where there's the greatest concern. I think what we're seeing right now, because we've seen it in the first administration of President Trump, I think we're going to see it in the second administration, this sort of distributive negotiating style and tactic where there's a lot of posturing in order to get to what the ultimate goal is. I think one of the key ultimate goals is to stop the transshipment of manufactured goods from China through Mexico, and also to prevent it, finished goods or relatively finished goods, from being transshipped through Canada in order to avoid tariffs. So that's what I think they're really trying to target, reducing the transshipped goods that come out of China, go to Mexico, and then get shipped north of the border into the U.S. That's what they're trying to reduce. And I also think President Trump is going to set a goal, obviously, of trying to increase border security and reduce the fentanyl crisis. Those are the things that are really top of mind. And right now, what we're hearing are things that are very concerning, especially for manufacturers and for importers. But I think a lot of it is posturing ahead of a distributive negotiating situation.
But creating or stopping the shipment of goods from China, even through those intermediary companies or countries, of course, yeah, the US does want to have things being built in America for American consumption. But creating factories at home takes time. So what happens in the interim period?
Well, that's right. It does take time to build up more of an industrial base that we have seen in the U.S. eroded over time, but we do have now kind of the biggest industrial base since the Vietnam War. It's not that the Trump administration would want to stop all imports from China. That's not the goal. The goal is to stop tariff avoiding imports, right? Where Chinese goods are coming out of China, going to Mexico, and then coming, right, because of the free trade, USMCA, NAFTA, they're able to come across the border without tariffs. Avoiding that circumvention through transshipment, that's what the administration, I think, really wants to target. And of course, that was negotiated. There is a part of the sunset clause that was renegotiated with the USMCA as part of that for review in 2026. Transshipments are clearly going to be up for discussion. And of course, they're going to be a priority for the administration long before we get to that 2026 review. It's really the circumventing of the tariffs, where the Chinese goods are being shipped or manufactured in a way to avoid tariffs. That's what I think the target's really going to be going forward. Building up a domestic base is going to take time. Mexico, you're seeing more manufacturing there. We're going to see more manufacturing over time, but making sure what's Chinese owned, what's Chinese imported, that's what's transshipped. That's where the focus is.
I'm curious, Jason, particularly where you are in Texas, what's the view of China economically? And are Chinese companies viewed as I'm curious, as economic threats?
Well, there is a U.gov poll that came out earlier this year that showed the vast majority of Americans, something like 80% of Americans, view China as the enemy. So this is a bipartisan issue across the United States. Under the Trump administration, you saw the Section 232 and 301 tariffs. Under the Biden administration, you have seen more tariffs, more trade restrictions. That executive order from last August that put restrictions on investments Americans and American companies could make in certain technologies of concern, or in certain technologies, AI, quantum semiconductors, microprocessors, in countries of concern, which included China, the Special Administrative Region of Macau, and the Special Administrative Region of Hong Kong. That restriction came out of the Biden administration. So we're going to see, I think, even more restrictions going forward, and that was going to happen no matter who was elected.
Jason, it comes down to, I think, in one major part, the strength in the U.S. dollar. And the reason I bring that up, I think you have the jobs report coming up this week. There's an OPEC meeting as well. I mean, let's help global investors here. They get this one right, they get half the equation right. Does the dollar remain strong in your view?
I think the dollar does remain strong. I do think it will be weaker at the end of next year than it is at the end of this year. But a lot's going really good for the U.S. You look at the IMF forecast, the U.S. was the fastest growing advanced economy in the world last year. This year, Spain is supposed to be a little bit stronger than the U.S., but the U.S. still coming in at the second fastest growing advanced economy in the world. That means not only is it the biggest economy, but it's one of the absolutely fastest growing advanced economies out there. It's a great place to send your money. I think that right now investors, they're looking at China. They're looking at the potential for a kinetic conflict between China and the United States over Taiwan. And they're thinking China looks like a great place to send your money if you never want to see it again. That's what investors are seeing. That's why you're seeing those FDI numbers are coming down so fast. Who are the big winners? India's seeing a spike in FDI. Mexico, the UAE, you're seeing lots of other unaffiliated, unaligned countries are seeing spikes in FDI, but money and business is coming out of China very quickly. And I think there is a lot of concern of what we're going to see going forward in a Trump administration. For the dollar, the biggest story is strong U.S. growth, strong jobs. Almost 69% of third quarter GDP in the United States was driven by consumption. We have lots of jobs in the U.S. The JOLTS data revised last month, we saw 7.7 million, over 7.7 million open jobs in the United States in the month of October. Lots of open jobs. Jobs report this Friday, likely to be solid, a rebound up from that October number, which was weak because of hurricanes and strikes. The U.S. economy looks good. Lots of tailwinds, optimism because the election, which could have been very tense and led to uncertainty and political violence, it was resolved and very clear who won the election. It was swift and it was decisive. Because of that, there's tailwinds and optimism for the dollar, for the U.S. economy in the year ahead, especially if the Trump tax cuts become permanent.
Jason, that sounds like the euro might hit parity.
I don't know if we're going to get exactly to parity, but the European economy is weaker. You look at that Eurozone manufacturing PMI; it's contracted for 29 consecutive months. It's a question. It could happen. It'll really depend, I think, on what we see in December if we're going to get towards the end of the year, because those Fed forecasts, they're going to probably include, again, additional cuts going forward as they did in September. I think it'll probably be pretty similar in terms of expectations of interest rate cuts. But if you're expecting more interest rate cuts, it's tough to say, well, the dollar's going to strengthen more if the ECB and the Fed are probably going to be cutting interest rates at about a similar pace going forward this year, even if the Eurozone economy is weaker. I think at the front half of the year, that's probably where you have the greatest chance of the dollar strengthening in Q1 as we see a spike in those CPI reports, the December report out mid-Jan. That's something to keep an eye on. But once we get into Q2, and that CPI and the other inflation measures start to fall closer to 2% or below 2%, that's where I think the dollar could weaken and expectations of more rate cuts could increase.
All right, Jason, we wanted to ask you about crypto, Bitcoin near 100K, but we've run out of time. That was Jason Schenker, their president and chief economist at Prestige Economics.